When you're trying to decide between T-bills or money markets as a place to earn interest for your short-term cash, there are three main variables that you need to evaluate to help you determine which is going to be the best for you. Number one, taxes. T-bills, money market accounts, which are offered by banks, and money market mutual funds, which are generally offered by brokerage firms, are all taxed differently. And you need to understand how the taxes work to help decide which is going to be the best one for you. Number two, fees. The fees can be more or less, and in the case of money market accounts offered by banks, sometimes they can have very high minimums. This factor is also going to influence your decision. And number three, liquidity. Your liquidity needs are going to help drive which of these three short-term investments is going to be best for you. T-bills are going to be the easiest and cleanest and the best deal when it comes to taxes. T-bill interest is 100% state tax exempt. When you get your 1099 from the brokerage firm where you bought your T-bills or from Treasury Direct, if you buy them from Treasury Direct, the 1099 will clearly show that the T-bill interest is from U.S. government securities. So when you do your tax return, or if your CPA does it for you, it's going to be easy to identify the amount of U.S. government interest and then take that deduction on your state tax return. But when it comes to money market mutual funds, it's a totally different story. The taxation of a money market mutual fund will be such that only some of the interest in the fund, the ordinary dividend that it gives you, that's how the interest is given to you in the form of an ordinary dividend, only some of that is going to be state tax exempt. And that is because money market mutual funds generally invest in T-bills and repurchase obligations. And those repos that they buy are not going to be state tax exempt. So what happens is when you get your 1099 from the brokerage firm where you bought your money market mutual fund, that 1099 is only going to show the amount of ordinary dividends that you receive throughout the year, but it will not tell you how much of your ordinary dividends from the money market mutual fund were state tax exempt because they were from T-bill interest. In other words, you won't know how much of your money market dividends were from T-bill interest. That creates a real problem. What happens that I see frequently is that CPAs and individual investors doing their own tax returns mess this up, unfortunately, all the time. Why? They simply don't take the state tax exemption, or the state tax deduction rather, for the T-bill interest that they earned. And that is because they just take the ordinary dividends, enter them on their tax return, and neglect to do the necessary tax research on the mutual fund. How you do that research to properly get your state tax deduction for the T-bill interest, how you do that research is you have to go to the administrator for the money market mutual fund that you have, research the particular tax year that you're looking at, and find out what percentage of your money market mutual fund's ordinary dividend for the year was from T-bill interest, i.e. U.S. government securities, and then manually make the adjustment on your state tax return. Otherwise, you have a problem. It's a big deal, and a lot of people miss it. So to me, one of the big differences between buying T-bills and buying a money market mutual fund that invests in T-bills for you is that you are likely to make a mistake with taxes, but also money market mutual funds that are taxable are not going to be completely state tax exempt because of the repos in the portfolio. That interest is not state tax exempt. Then we have to look at how our money market accounts, which are just deposit accounts offered by banks. And it's confusing. It's money market account sounds a lot like money market mutual fund, but they're a world apart in terms of taxation and in how they are invested. A money market account at a bank is just a deposit account. Now, the benefit to a money market account is that that account is going to be FDIC insured. But the problem, the major con to a money market account, is that 100% of the interest is going to be taxable at the state level. It's just a deposit account. So in my opinion, when it comes to taxes, the best that you can do for your short-term cash is going to be T-bills. The second best is going to be a money market mutual fund that you would get at a brokerage firm like Fidelity or Vanguard or Schwab. And the third best, and a very distant third, is going to be a money market account offered by a bank. When it comes to fees, T-bills are going to be your best deal. You can open an account with Treasury Direct for no fees. It doesn't get any better than that. If you buy your T-bills through a brokerage firm like Fidelity, there will be a de minimis spread or commission when you buy that T-bill. It'll be a lot smaller in cost than if you were to invest in a money market mutual fund. Money market mutual funds have an annual expense ratio. And if you study the yield between T-bills and most money market mutual funds, you're going to find that the T-bill has a higher yield by an amount close to the expense ratio of the money market mutual fund. In other words, the money market mutual fund is going to offer you less yield than a T-bill outright by the amount of the expense ratio. Money market accounts offered by banks often have a very high minimum amount that you must maintain there to earn the highest rate. So in order to get their best interest rate from the bank, you have to have a lot of money on deposit there. And why do they do that? Because the more money that they get from you, the more loans that they can create. When the bank gets your money in that money market account, they're lending it out. I would much rather have, personally, a T-bill or a money market where your money is invested in something versus a deposit account at the bank where your account is really a liability to them because they're lending your money out. But here again, we see the order in terms of what's going to be best for most people. Number 1, T-bills. Number 2, money market mutual funds. And number 3, money market accounts. Liquidity. While all 3 of these investment options are extremely liquid, there are some nuances with T-bills that you need to be aware of. If you need money before your T-bill matures, you can sell it. And unlike a CD, you're not going to have a penalty when you sell. You're going to sell your T-bill for the current market price. So if you have your account with a brokerage firm, you need to know how to navigate the buying and selling tools of that brokerage firm to sell your T-bill if you need liquidity before the bill matures. If you have your money in T-bills at Treasury Direct, there's more of a hassle there. It is possible for you to transfer the T-bill out to a brokerage firm and sell it, but that's a bunch of administrative work that you don't want to engage in. If you're going to buy T-bills at Treasury Direct, I think it's best to plan on having them be somewhat illiquid and holding them until they mature. So from this perspective, liquidity, money market accounts and money market mutual funds are generally the easiest and the best. If you buy your T-bills through a brokerage firm and you know how to navigate the brokerage firm's tools, you can always sell your T-bills prior to maturity if for some reason you need cash. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.